In this video, we will discuss a little bit about banking regulation and the computation of the capital adequacy ratio. Now, as you might know, the banking industry is one of the most heavily regulated industries in the whole world, and this is because the cost of failure is extremely high. So, banking regulation has come into play to reduce the risk of collapses in the banking industry. In other words, to prevent bank runs. What is a bank run? A bank run is when the public loses confidence in one or multiple banks and as a result queue up to withdraw all their funds, draining out all the liquidity from the banking system. In the Great Depression of the 1920s, you will find many pictures laying around on the internet where people are queuing up for kilometers to take out their money. So you can understand how the failure of one bank alone is enough to trigger an illiquidity collapse or an illiquidity shock throughout the entire banking system. That's why regulators put a lot of emphasis on making sure that there's enough liquidity and the banks are solvent over the long term, meaning they are adequately capitalized. And as an extra layer of precaution, the central bank acts as the lender of last resort to ensure that any immediate liquidity or capital shortfall can be mitigated on a short-term basis. So I'm sure all of you understand by now why it is important for a bank to have adequate amount of capital. In addition to those reasons we have discussed before, banking regulation also tries to ensure that bank runs do not happen by promoting confidence in the entire financial system by sending a signal to the depositors that the bank is healthy and your money is safe. The money that you put into the bank, you will be able to get it back at any time that you desire. So there's no risk of the bank running away with your money or you losing your money. Furthermore, regulation ensures that there is enough capital to act as a shock absorber for bad debts, non-performing loans, and other extraordinary situations. It also helps the bank to expand into different territories and offer a wider scope of products and services. But how exactly do we know if a bank is adequately capitalized? For this, we will rely on a metric called the CAR, or the Capital Adequacy Ratio. So the name itself tells you that it's a ratio. There is a numerator and there is a denominator. Now the numerator for CAR is the capital, and the denominator is the size of the bank. That is the total assets. But we're not concerned with just the size of the asset, but rather the risky assets. So we're going to modify the assets according to their risk classifications. For this, we will engage in something called credit risk weights. So the denominator of the CAR will be determined by multiplying the bank's assets by the CRW, or the credit risk weight. The four credit risk weights are 0%, 20%, 50%, and 100%. As for the numerator, we have all the capitals. So we have two tiers of capitals here. Tier 1 includes the paid up ordinary share, the reserve, and the retained earnings. And the Tier 2 capital is a reserve of securities and a provision for doubtful debts or debt write-offs. According to the Basel framework, the Tier 1 capital has to have at least 4% of the total risk-weighted assets. So focus now on slide 48. How do we calculate the CAR? There are four main steps for you to remember. First, you have to estimate the capital base, which includes the Tier 1 and Tier 2. Refer to slide 46 for them. Then, calculate the total risk-weighted assets. Calculate the total market risk-weighted assets. Then you can arrive at the CAR by dividing the capital base by the total risk-weighted assets. And after plugging in those information into the numerator and denominator, the ratio that you will get, that has to be more than 8%. Otherwise, the bank is not adequately capitalized. If this sounds confusing to you, let's take a look at a numerical example. Slide 49. We have $100 million in corporate loans. We possess $100 million in cash and $100 million in Fed Treasury bills. Now we have to assign some risk weights for these because not all of them carry the same amount of risk. For example, cash doesn't carry any risk at all. We have the cash. We're not losing that cash. Similarly, the U.S. Treasury bill is considered to be a riskless security because it is backed up by the confidence that the investors and the general public have on the ability of the U.S. economy and the U.S. central bank to issue new funds. So the Fed's not going to run out of money. As a result, we are going to assign a zero risk weight to the U.S. T-bills. But on the other hand, the corporate loans is 100% risky. And by 100%, we mean that there's every possibility of a default present in there. So we're going to treat that as a 100% risky asset. Of course, this doesn't mean that we are going to lose all of this money or we are expecting a 100% default across all of our corporate clients. It just means that we are acknowledging 100% that these loans are risky. So let's multiply them. We have $100 million in corporate loans times 100% plus $100 million in cash times 0% plus $100 million in T-bills times 0%. So our total risk-weighted assets are going to be $100 million. So that's our denominator. But what about the numerator? Tier 1 and Tier 2 capital. We are told that we have $8 million of those. So our CAR is going to be Tier 1 plus Tier 2, which is 8 million, divided by the risk-weighted assets, which is 100 million. So the final answer is 8%. So this bank satisfies the requirement of capital adequacy. But keep in mind that there's a small little clause in the bank capital which says that the Tier 1 capital must account for at least 4% of the total risk-adjusted assets. So always make sure that if this question comes in the exam, that the Tier 1 capital satisfies this criterion.